Your credit score is either making you rich or making you poor, and most people have no idea which one it is doing to them. Right now, your credit score controls more of your financial life than you think. It controls whether you get approved for an apartment. It controls the interest rate on your car loan. It controls whether the bank gives you a mortgage. It controls how much you pay for insurance in some states. And it controls whether you can borrow money in an emergency. One number. 3 digits, and it is either working for you or working against you every single day, whether you know it or not. Today, I'm going to show you exactly what your credit score is, how it is calculated, why it matters so much, and most importantly, how to raise it fast. Even if your credit is bad right now, even if you have never thought about it before in your life, even if you have missed payments, maxed out cards, or made every mistake possible, it is not too late. And by the end of this video, you will know exactly what to do. Welcome back to USA Money Explained. I'm UNUS. If you've been following this series, you already know how to invest your first $1,000, how to build your emergency fund, how compound interest works, how to budget with the 50-30-20 rule, how to destroy your debt with the debt snowball, and how to start a side hustle with $0. Today, we fix your credit score. Because a good credit score is not just a number, it is a financial superpower. And a bad credit score is a financial anchor, dragging you down every time you try to move forward. Let me show you why this matters so much. Let's say two people both want to buy a home. Same city, same income, same down payment. Person A has a credit score of 760. Person B has a credit score of 620. They both take out a $300,000 mortgage. Person A gets an interest rate of 6%. Person B gets an interest rate of 8.5%. Over 30 years, Person A pays $347,000 in total interest. Person B pays $499,000 in total interest. Same house, same loan amount, same city, but person B pays $152,000 more just because of their credit score. $152,000. That is a second house. That is full retirement savings. That is your children's college education gone just because of 3 digits. That is the power of a credit score. And it's not just mortgages. Car loan with good credit, 5% interest. Car loan with bad credit, 15% interest. Credit card with good credit, 15% APR. Credit card with bad credit, 29% APR. Even renting an apartment, landlords check your credit score. Some employers check your credit score before hiring you. This number follows you everywhere. So let's make sure yours is working for you. Now, let me explain exactly what a credit score is. Your credit score is a number between 300 and 850. It is calculated by companies called credit bureaus. The 3 main ones in the United States are Equifax, Experian, and TransUnion. Each one collects information about your borrowing and repayment history. The most commonly used score is called the FICO score, named after the Fair Isaac Corporation, the company that created it. Here's how the ranges work. 800 to 850, exceptional. You get the absolute best interest rates on everything. Lenders are competing to give you money. 740 to 779, very good. You still get excellent rates very close to the top. 670 to 739, good. Most lenders will approve you with reasonable rates. 580 to 669, fair. You'll get approved sometimes, but with significantly higher interest rates. 300 to 579, poor. You'll struggle to get approved for almost anything, and when you do, the rates will be painful. The goal is to get above 740. That is where the real financial benefits begin. That is where lenders see you as low risk. That is where your money starts working harder for you. Now, let me show you exactly how your credit score is calculated, because once you understand this, you will know exactly what to fix first. There are 5 factors, and each one has a specific weight. Factor number 1, payment history. This is 35% of your score. It is the single most important factor. Do you pay your bills on time? Every single time. One missed payment can drop your score by 50 to 100 points. Think about that. One missed payment. That could knock you from good to fair, from fair to poor, from qualifying for a mortgage to being rejected. One single missed payment. This is why autopay exists. Set up autopay for every single account right now. Every credit card, every loan, every subscription. Minimum payment autopay on everything. Then pay more manually when you can, but never miss the minimum. Never. Factor number 2, credit utilization. This is 30% of your score. Credit utilization is how much of your available credit limit you are using. If your credit card limit is $1,000 and your current balance is $500, your utilization is 50%. That is too high. The rule is to keep your utilization below 30%, ideally below 10% if you want an excellent score. If your limit is $1,000, keep your balance under $300. If your limit is $5,000, keep your balance under $1,500. If your limit is $10,000, keep your balance under $3,000. Here's what most people don't know. Your utilization is calculated on each individual card, not just overall. So if you have 5 cards and one of them is maxed out, that one card is hurting your score. Even if all the others are empty, keep every single card below 30%. The lower, the better. Factor number 3, length of credit history. This is 15% of your score. How long have you had credit accounts open? The longer your history, the better your score. This is calculated as the average age of all your accounts. This is why you should never close your oldest credit card. Even if you hate it, even if you don't use it, even if it has an annual fee, call and ask them to downgrade it to a free version, but keep it open. Closing it could drop your score immediately. Keep old cards active with one small purchase every few months. Pay it off immediately. This keeps your history long and your utilization low. Factor number 4, credit mix. This is 10% of your score. Do you have different types of credit? Credit cards, revolving credit, car loans, installment credit, student loans, installment credit, a mortgage, installment credit. Having a healthy mix of different types of credit shows lenders you can manage different kinds of debt responsibly. You don't need to go out and get every type of credit, but having a mix naturally over time does help your score. Factor number 5, new credit inquiries. This is 10% of your score. Every time you apply for a new credit card or loan, the lender does a hard inquiry on your credit report. This temporarily drops your score by 5 to 10 points. It recovers in a few months, but if you apply for multiple cards or loans at the same time, multiple inquiries stack up and your score takes a bigger hit. Do not apply for multiple things at once. Space out your applications. Only apply for credit when you actually need it. Now, let me give you the complete action plan to raise your credit score. Step 1. Check your credit report for errors. Go to annualcreditreport.com. This is the only official government-authorized free site. You can check all 3 bureaus, Equifax, Experian, and TransUnion, for free, once per year officially, but right now you can check weekly for free due to a pandemic policy extension. Look for accounts you don't recognize. This could be identity theft. Look for payments marked late that were actually on time. Look for incorrect balances or credit limits. Look for accounts that should have fallen off your report after 7 years. Errors on credit reports are shockingly common. Studies show 1 in 5 Americans has an error on their credit report, and disputing an error, if found, can raise your score by 50 to 100 points instantly without changing any behavior, just by correcting a mistake. Step 2. Never miss a payment again. Ever. Set up autopay on every single account today, even the minimum payment. This protects your payment history, 35% of your score. One missed payment stays on your report for 7 years. 7 years. Autopay takes 5 minutes to set up. Do it today. Step 3. Aggressively pay down your credit card balances. Get your utilization below 30% on every card. This is one of the fastest ways to raise your score because utilization updates every month when your statement closes. Pay down your highest utilization card first, then the next, then the next. Even getting one card from 50% to 25% utilization can raise your score by 20 to 50 points within 30 days. Within 30 days. Step 4. Ask for a credit limit increase. Call your credit card company and ask them to raise your credit limit. Do this without spending any more money. If your limit goes from $1,000 to $2,000 and your balance stays at $500, your utilization just dropped from 50% to 25%. Your score improves without paying a single extra dollar. Most credit card companies will approve a limit increase if you've been a customer for 6 months and paid on time. Just ask. The worst they can say is no. Step 5. Become an authorized user. Ask a family member or trusted friend with excellent credit to add you as an authorized user on their oldest credit card. You don't even need to use the card. You don't even need to carry it. Their entire payment history on that card gets added to your credit report. Their on-time payments become your on-time payments. Their long credit history becomes part of your history. Your score can jump by 30 to 50 points from this one step alone. This is one of the fastest and least known credit building strategies. Step 6. Don't close old accounts. I said this in the credit mix section, but it's important enough to say again. Never close your oldest credit card. Closing it hurts your score in two ways simultaneously. First, it shortens your average credit history. Second, it reduces your total available credit, which raises your utilization. Double damage from one action. Keep old cards open. Lock them in a drawer. Use them once every 3 months for a small purchase, a tank of gas, a grocery run. Pay the balance off immediately and keep the account alive. Step 7, be patient and stay consistent. This is the hardest part for most people. Raising your credit score is not instant, but it is reliable. If you follow these steps consistently, you will see noticeable improvement within 30 to 60 days, significant improvement within 3 to 6 months, and excellent credit within 12 to 24 months. The people who fail at building credit are the people who give up after 2 months because they do not see instant results. The people who succeed are the ones who set up autopay, lower their balances, and check their report month after month after month. Consistency is everything. Now let me talk about the most common credit score mistakes. Mistake number 1, only paying the minimum. Paying the minimum keeps you out of default, but it keeps your balance high, which keeps your utilization high, which keeps your score stuck, and you pay enormous amounts of interest. Pay as much as you can above the minimum every month. Mistake number 2, closing paid off credit cards. I know it feels good. You paid off the card, now you want to cut it up and be done with it. But do not close the account. Keep it open with zero balance. It helps your utilization and your length of history. Mistake number 3, applying for multiple credit cards at once. Every hard inquiry temporarily drops your score. Multiple inquiries in a short period look desperate to lenders. Apply for one thing at a time, only when you need it. Mistake number 4, never checking your credit report. Most people have never looked at their credit report. They have no idea if there are errors, no idea if someone has opened a fraudulent account in their name. Identity theft is more common than ever. Check your report at annualcreditreport.com at least twice per year. It's free, it takes 20 minutes, and it could save you from a disaster you don't even know is happening. Mistake number 5, maxing out a new credit card. Getting a new card and immediately spending up to the limit spikes your utilization and drops your score immediately. A new card is a tool. Treat it like one. Keep the balance low, pay it off monthly. Let it help your score, not hurt it. Now, one final mindset shift. Your credit score is not a measure of your intelligence. It's not a measure of your worth as a person. It is not permanent. It is a tool, a system. And like any system, once you understand how it works, you can make it work for you. Bad credit is not a life sentence. Good credit is not reserved for people who were born rich. It's built with simple habits over time. Pay on time, keep balances low, do not apply for credit you don't need. Check your report for errors, and be patient. Do those 5 things every single month for 12 months, and your financial life will look completely different. That 3-digit number will stop being something that works against you and start being the financial superpower it was always meant to be. So let's do a quick recap, USA Money Explained style. Credit score ranges from 300 to 850. Aim above 740. Payment history is 35%. Set up autopay on everything today. Credit utilization is 30%. Keep every card below 30%. Length of history is 15%. Never close your oldest card. Credit mix is 10%. Variety of credit types helps over time. New inquiries is 10%. Only apply when you actually need credit. Check your credit report free at annualcreditreport.com. Pay down balances to lower utilization fast. Ask for a credit limit increase without spending more. Become an authorized user on a trusted person's account. Stay consistent, 30 to 60 days for first results. That's it. That's how you turn 3 digits into a financial superpower. If this video helped you, hit that subscribe button right now and watch the final video in this series, right here, the stock market for beginners. Because once your credit is strong, your debt is gone, and your income is growing, it's time to build real, lasting wealth. I'm UNUS. See you in the next one.